How do lenders calculate your income when you're self-employed? Well, first of all, it's not black magic. It's very, very straightforward. It's just very different than what you might expect. Before I dive into this, I want to be clear. I'm going to show you how we look at tax returns. Now, for the best qualification, for the best terms, we're going to use your tax returns to qualify you. If you don't qualify using your tax returns, I have alternative methods. We can use bank statements, we can use your P&L. There's lots of other ways that we can go about proving your income, but you're typically going to get the best terms, lowest interest rate, lowest fees, smallest required down payment by using your tax returns to prove your income. So there's a document called the Fannie Mae 1084. You don't need to care about that, but it's a document I'm about to share with you because it's how the federal government, Fannie Mae, Freddie Mac, require us to look at your tax returns. Now, there's some nuances here that might be different with FHA versus VA, but I'm going to dive in and give you kind of a big picture of what we're looking at and why. If you are a sole proprietor, we're going to look at a Schedule C, and Schedule C is for people who are owning their own business that is not a partnership, a corporation, S Corp, or a C Corp. And so we're going to look at your net profit. We're going to go to the bottom, not the top. Everybody assumes we look at the top. The problem is the number at the top is how much you brought in receipts. And you're going to say, yeah, but John, all those expenses in the middle, those aren't real expenses. Like, I put a lot of extra stuff in there. Well, then we may have to look at an alternative way of qualifying you because the federal government is backing this money. And the federal government's made it clear, we don't want to back a mortgage on income you didn't show us through the IRS. So we're going to look at your profit down at the bottom. Now we're going to add back in, actually, I'm going to say first, we're going to subtract non-recurring other income. So there's a line up at the top that is right before your net revenue that says other income. And we have to figure out what's the other income. The definition of other income is income that is not part of your normal practice of business. So maybe you are a grocery store, a convenience store, you get a portion of the lottery winnings. Now, you're not in the lottery business. Your sales of lottery tickets counts as regular revenue, but you get a split on the winnings. Your business is not about winning lottery. So therefore, that shows up as other income. Maybe you are a dairy and you produce cows. Well, then in the end, you might sell the cow for the meat. Well, that might actually count as capital gains, but that's a different story. That would be other income theoretically. If your accountant can put it in capital gains or they can put it in other income because your business is not raising cows for sale. Your business is raising cows to milk. But once they've reached their production level and you can't milk them any longer, then you're going to sell the cow, and that would be other income. If other income is recurring, we can use it. But if it's not recurring, we can't. We have to ignore the other income. All right, we're going to look at depletion and depreciation. What are depletion and depreciation? That's money that you got to write off as an expense, but it wasn't money you wrote a check for that year. So when you look at the bottom line profit, we say, yeah, but that year you really didn't write a check for depreciation or depletion. We get to add that back in. That helps you in qualifying. The next thing we do is we look at non-deductible travel and meal expenses. Now, what does that mean? Non-deductible travel and meal expenses basically is, hey, you spent $1,000 a month in meals and entertainment, and therefore you spent $12,000 for the year. But the IRS says for most business owners, you can only write off half of that. So you can only write off $6,000. So you're going to show $6,000 in your meals and entertainment, but we're actually going to count the other half. So we're going to double it. Now, if you're a long haul truck driver, you actually get to write off 80% of your meals and entertainment. So we're only adding back in the other 20%. A lot of lenders miss that for long haul truck drivers. All right. And then we're going to add back in business use of home. Why? Because you're paying a mortgage and you're going to get a new mortgage. And so we're already going to hit you for the mortgage payment, even if you're paying rent today. We're already going to hit you for the replacement for your rent, which is the mortgage payment. We don't need to double count the home expenses. So we get to add back in business use of home. And then we get to add back in amortization and casualty losses, because again, those are one-time thing. Casualty loss is a one-time thing. Amortization is just the expense of the interest over time. So we're gonna add back in those lines. We get to look at your capital gains and losses. We get to look at your rental and your royalty income that comes from the Schedule E. Farming, same thing. And then it becomes more complicated if you're a business owner. So I'm not going to, not business owner, if you're a corporation. I'm going to dive in a separate video and talk about being a corporation and how we look at your income as a corporation compared to how we look at your income as a Schedule C, which is what we went through today.